Okay, it's senior internet analyst Mark Schmolik and Moatti Capital founding partner SC Moatti. See, this is what happens. We got a busy earnings afternoon. We got breaking news. It's very exciting right now. Okay, so SC Moatti is the shareholder of the company and she's a former Facebook exec. Welcome to you both. SC, I'll start with you, given the fact that you did used to work for Meta and the fact that you do own stock in this company. Your initial reaction to the results we just got?
Well, I would say it's not surprising. I think the company, just based on my experience on the inside, is very resilient. They've declared a year of efficiency, and so that's going to position them very well. They have a few things going for them. One is they're aggressively leveraging technology. When I worked there, it was mobile. Today, it's AI. I think that's going to allow them to really win market share in advertising against Google, who's really struggling with AI, and is also going to allow them to, win against the Apple app privacy policy. The other thing that I think is going great for them is that TikTok is right now under regulatory scrutiny. Now, when I was there, their way to react to competitive threat was to simply acquire a company like they did with Instagram and WhatsApp. I think it's going to be hard for them to acquire TikTok because of the regulatory pressure. But the fact that TikTok is now under scrutiny is an opportunity for them to basically beat that competition.
Okay. Mark, how much farther can this run? I mean, we did get top line growth from them, which was in doubt, but we also got expense growth that's growing faster, even though they sort of capped off what they said they're going to spend. Can this stock continue to run without even more top-line growth? Is it still a doubted stock, or is the optimism built in?
Hey, John, no, I think the optimism's built in, especially on the cost takeout side. I think the year of efficiency is done. Not to say they won't be more efficient, but this is no longer a cost takeout story. This is now, if you want to be valued like a growth stock, which is really where the upside is, you've got to be growing. And I think they absolutely delivered that this quarter. And perhaps more importantly than the actual growth rate of 3% for the quarter, it's the midpoint of the guide, suggests it's going to accelerate up to about kind of 7-8% on a constant currency basis. That's the trend you want to see for a company that needs to get back into double-digit growth for the stock to continue to work.
So given the fact that this is a stock that was up something like 140% since the third quarter results that were seen as so disastrous by the street, when Meta was basically saying they were going to spend even more and continue to double down on the metaverse investments. And then, of course, we know reverse course. Do you buy in at these levels, or do you wait for a more meaningful pullback, Mark? I mean, the stock's up 10% right now after hours.
No, I think you continue to buy and hold. It's certainly not expensive. It's still trading at a discount to the market. And I think a lot of that was a self-inflicted wound that happened at the end of the third quarter where, investors effectively hate sold the stock because they felt that the management team there really didn't care about things that matter to investors and weren't disciplined enough to kind of keep costs in check. And we've seen pretty much, a full 180 from the company where they've taken out about 10% of their OPEX, something like 15% of their CapEx that they had effectively committed to. So we've got a much leaner, more efficient company coming off the bottom here. And as I mentioned, still very much not expensive if you believe top line's getting back to double-digit growth.
All right, Mark, SC, thank you.